why long-term investors need to consider climate risks. And again, the invitation is there. Please do make your post your questions or comments in the chat function, which Stefaku and Seren will be monitoring. And of course, if you would like to make a comment, audibly or verbally, with or without your video camera on, you can also just raise your hand, and we'll do that. So I think from the example of the Japanese pension fund, the GPIF, I think it's quite clear that investors can't avoid environmental, social, and governance issues across their portfolios, and they can't avoid exposure to climate risk. And this is supported by the UN Principles for Responsible Investment, which is the world's largest and leading global collaboration by investors such as retirement funds and fund managers wanting to collaborate on systemic risks and ESG issues or sub-themes, many of which are systemic risks. Examples could include climate risk, but also other examples like alignment of interest when it comes to executive remuneration and incentives, sustainable agriculture, palm oil. There's an endless list of thematic areas that investors from around the world could get involved in supporting. So, why does climate change matter to investors? Well, at the end of the day, you as an investor, and especially retirement funds, are investing for future cash flows or future revenues that you hope to realize by giving money as an investor into other businesses, as those businesses do well and they're able to return some of their profits to their shareholders. And you're making an investment into the future, and climate risks and some ESG risks are future risks that are going to be more prevalent over the short or medium term. Some examples, but then others will be more on the medium and long-term kind of risk profile. When one thinks about climate change, in Seren's presentation, we would have learned about physical and transition risks. Most of us are familiar with the physical risks of climate change, like drought conditions, fires, extreme periods of heat or cold, extreme weather events, ocean surges or tsunamis to a certain extent, and very destructive physical knock-on effects from climate risk. Transition risk, which is again being invested in certain sectors of the economy, like coal mining, for example. It's likely that it's going to be more difficult for coal mining companies to remain profitable when investors, especially our international investor counterparts, are starting to divest from coal-intensive assets or carbon-intensive assets. And so there's a potential that we are valuing assets at today's value and trying to estimate future cash flows, which could very well be at risk or become stranded because we'll never really be able to achieve or realize those investment returns that we think we're going to get today because of the global transition to a low carbon economy. Climate risks are systemic issues which affect all asset types and sectors. If you think about a carbon tax, for example, each and every organization is somehow connected to the South African electricity power grid. And as I mentioned earlier, Eskom is the electricity utility provider in South Africa, which makes extensive reliance on coal for our power supply. And so if you are in production or manufacturing and you making use of electricity, the likelihood of you starting to pay a carbon tax is significant. In actual fact, if you want to buy a new vehicle or a new car today, and you go to the dealership and you're signing the papers, you will see that there is a line item that you need to pay, and that is a carbon tax. So already we are starting to feel the impacts of this transition to a low carbon economy as government and policymakers are trying to um, internalize some of these external or externalities, which previously we haven't had to pay for. But as we are putting a price on carbon and as we are starting to tax carbon, it's going to become more and more prevalent for investors, irrespective of what area or industry that you're invested in, especially in the context of South Africa, where we are all linked for the most part to the Eskom power grid. And so this will definitely impact on investment returns, especially in the long term, as well as asset valuations. So the value of companies can change. And an example of how a company, valuation has changed, not because of climate risk, but for example, Naspers or Prosus and their big investment in Tencent, which is one of the world's global kind of largest Chinese-based kind of technology companies. They sell online games and WeChat and that type of thing. With the Chinese government crackdown on kind of software companies or tech companies, and kind of limiting the hours of gaming for children in China, there's been a massive impact on the investor confidence because of business being more challenging under this additional kind of regulatory environment in China. Already we've seen the valuation or the market value of those assets starting to drop. And so immediately that then starts asset managers and investors thinking around, well, is Naspers or Prosus, still such an attractive investment relative to some other investments that we could invest in, which are giving us more or less the same financial returns. So climate change is no different. It's going to force investors to consider their investment choice decisions and how they allocate their investment allocation to different sectors and businesses. So that's on the risk side. On the opportunity side, climate also provides plenty opportunities for more sustainable ways of producing electricity. Again, kind of smart agriculture, renewable energy, infrastructure assets, where instead of us all going to work in our own cars, our private vehicles, where you've got one or two people in a private vehicle, let's rather see more people using public transport. Finding more efficient ways to produce goods and services. So it really does allow for innovation. And there's an added driver for innovation when one is starting to tax things like carbon, because there's a cost-saving rationale as well. Different countries and sectors have their own, risks as well. And South Africa, for example, because of our distance from our trade partners, especially if one thinks of Europe and the UK and the US, who are increasingly starting to, apply tariffs to, carbon-intensive trade partners, it's going to make us more and more. It's going to make it more and more challenging for us to compete on a level playing field, because we are so much further than a lot of our trade partners and our kind of trade markets. So getting our fruit and vegetables, and whether it's blueberries or oranges, to market in Europe and elsewhere, because of the distances that need to be traveled, that can very much impact on how attractive our goods and services become, from a climate lens. And then lastly, investors around the world are starting to apply an ESG lens to a far greater degree. Internationally, there's been a number of developments confirming that fiduciary duty, this duty of care. When we invest other people's money, we need to do so more cautiously than we would even working with our own money and investments. Because ESG risks can very quickly present themselves as financial risks, and have an impact on financial performance, more and more regulators and court cases around the world have been confirming that the consideration of material or relevant environmental, social, and corporate governance issues is very much a part of your fiduciary duty. How to properly take care and manage your client or stakeholder beneficiary assets on their behalf. And so we're seeing a lot of focus on climate change as a material systemic risk, a long-term risk that long-term investors like retirement funds need to increasingly consider. We're going to move into a polling question quickly. And in terms of your confidence level, we'd like to understand how confident would you feel in engaging in a discussion on the task force on climate-related financial disclosures. And again, we haven't presented on this yet, so if you haven't encountered the TCFD before, there's no harm in answering that you're not confident at all, or that you're not confident. Perhaps you have already come across TCFD and you're a bit more confident or very confident in that you've done some studies into the TCFD and what it's all about. So please take a moment just to respond to that polling question. Are you not confident at all? Are you not confident? Are you confident or very confident? And as would probably be expected, TCFD is still quite new for a lot of people. 2/3 of our audience are not confident at all. So low familiarity with the TCFD framework, whereas 1/3 of our participants are confident, and that's good to hear. So definitely an opportunity to improve on confidence levels. So we can end the poll there and share the results. And then we're going to move on in terms of our